All right, all you future accountants out there, ever wonder how a company actually keeps track of its biggest physical assets? You know, the buildings, the machines, the vehicles. Well, today, we're going to demystify one of the absolute cornerstones of financial reporting, IAS 16, all about property, plant, and equipment. And look, to make this super practical, we're going to follow one simple question through this whole explainer. How does a company deal with, say, a delivery van from the second it's bought to the day it's sold off? IAS 16, believe it or not, gives us the complete rulebook for that entire journey.
So here's our game plan. We'll start with what IAS 16 even is. Then we'll follow the asset's life, from recognizing it on the books to tracking its value with 2 different models, and then dealing with depreciation and impairment. We'll wrap up with its final chapter, getting it off the books, and finally, look at the rules that make sure the whole story gets told.
Okay, let's dive right in. So what exactly is IAS 16? Well, you can think of it as the official rulebook for a company's big, physical, tangible assets. At its core, the whole point of IAS 16 is to make sure everyone's playing by the same rules when it comes to accounting for property, plant, and equipment, or PPE, as you'll hear it called. It answers the big questions. When does something officially become an asset? What's it worth? And how do we track its value as it changes over time? Having this consistency is absolutely crucial if you want to compare one company to another. Okay, next up, the very first stage. Let's call it the birth of an asset. How does our delivery van officially make its debut on the company's balance sheet? IAS 16 gives us this really clear 2-part test. First, is it probable that this thing will bring future economic benefits to the company? For our van, is it going to help deliver goods and make money? Yeah, for sure. Second, can we measure its cost reliably? Do we know exactly what we paid for it? If you can answer yes to both of those questions, boom, you've got yourself an asset. So once an item passes that 2-part test, it gets put on the books at one thing and one thing only, its cost. That initial price tag is always the starting point for its entire accounting life. But here's the kicker. Cost is a way bigger deal than just the price on the invoice. IAS 16 is super clear about this. Cost includes every single expense you need to get that asset to the right location and in the right condition to do its job. For our van, it's not just the purchase price, it's the delivery fees too. And imagine a giant factory machine. The cost would include installation, getting the site ready, and even the estimated cost to tear it down someday. Okay, so our van is officially on the books at its initial cost. Great. But what about next year or in 5 years? This is what we call subsequent measurement. And this is where IAS 16 gives companies a really big choice to make between 2 totally different models. So companies have to pick one of 2 paths, and this choice makes a huge difference on the balance sheet. The cost model is the simple, straightforward one. You just take the original cost and subtract depreciation year after year. But the revaluation model is way more dynamic. With this one, you're constantly updating the asset to what it's actually worth on the market. A company with a fleet of trucks might just stick to the simple cost model, but say a real estate firm with buildings in hot locations, they might use the revaluation model to show those rising property values. So what happens if you revalue that building and its value shoots up? Well, that gain usually doesn't hit your profit for the year. Instead, it goes into this special little pocket in the equity section of the balance sheet called the revaluation surplus. It's kind of like an unrealized gain. You have it, but you haven't cashed it in yet. But what if the value goes down? That's a different story. In that case, the decrease is usually recognized right away as an expense, and that hits the company's profit for the year. The general rule is pretty simple. Gains go to equity, but losses hit your profit. And this right here highlights one of the most important rules of the reevaluation model: no cherry picking. If you decide you want to revalue one of your delivery vans, you have to revalue your entire fleet of vans. This stops companies from just revaluing the stuff that's gone up in value and ignoring the rest. It's all or nothing for that class of asset. Now, it doesn't matter if a company picks the cost model or the revaluation model. There are 2 concepts that apply to everyone: depreciation and impairment. This is all about accounting for the using up of an asset and any unexpected drops in its value. So depreciation isn't about the asset's market value dropping, it's a process of allocation. You take the asset's cost, you subtract what you think you can get for it at the very end, its scrap value, and that gives you the depreciable amount. Then you just systematically spread that amount as an expense over the years you plan to use it. It's all about matching the cost of the asset to the revenues it helps you earn. But see, depreciation is the plan. What happens when things go wrong? an unexpected sharp drop in an asset's value. That's where impairment comes in. IAS 16 has a golden rule. An asset's value on your books can never, ever be higher than what you can get back from it. Its recoverable amount.
And this recoverable amount is a really key idea. It's defined as the higher of two numbers, what you could get if you sold it today versus the value it'll generate for you by just continuing to use it in the business. If the asset's book value is higher than that recoverable amount, the company has to take an impairment loss to write it down.
And here we are, the end of our delivery van's journey. Its final chapter is called derecognition. This is just the formal process for taking an asset completely off the books. The rules for this are really simple. You take an asset off your books in two situations. 1, you get rid of it. You sell it, you scrap it, you trade it in. Or 2, you just stop using it for good, and you don't expect to get any more value out of it. Basically, it's got to go when it's gone or when it's become useless.
And when you do derecognize an asset, you have to figure out if you made a gain or loss. It's simple math. You just compare what you got for it, the proceeds from the disposal, with whatever its value was on your books at that exact moment. And that difference, it goes straight to your profit or loss statement for the year.
So we've covered the whole life cycle, right? But financial reporting is all about being transparent. So our final section is all about what companies must tell people to paint the full picture of their property, plant, and equipment.
IAS 16 demands a lot of detail, and it has to be broken down by each class of asset. So you'd have one for buildings, one for vehicles, one for machinery. For each of these classes, a company has to spell out which measurement model it's using, what depreciation methods it's using, and a full-blown reconciliation, showing the value at the start of the year, all the additions, disposals, and depreciation, and the final value at the end of the year. And if a company is using that more complicated revaluation model, the transparency rules get even stricter. They have to disclose when the revaluation happened, if they used an independent expert, and, this is really important, what the asset's value would have been if they just used the simple cost model. This lets investors compare apples to apples, even if companies are using different methods. And that brings our journey through IAS 16 to a close, but it leaves us with a really important question to noodle on. Does that revaluation model, with its up-to-the-minute fair values, give you a truer financial picture? Or does the nice, steady, predictable cost model actually make things clearer for investors? There's no single right answer, and it's a debate that really gets to the heart of all the judgments that go into accounting. And that's something for you to think about as you continue your studies.